Welcome to The Explainer. Today we're diving straight into a totally massive, data-driven option setup for APLD. A huge catalyst just hit the wires, so we're going to tear down the chart, dig into the technicals, and figure out exactly how to deploy a defensive, cash-secured put strategy. Let's get right into it.
Here's our game plan for today. We'll look at the hyperscaler breakout, map out the technical indicators, go over the exact trade setup and rationale, and finally, lock in our defensive safety net.
All right, Section 1, the hyperscaler breakout. $7.5 billion. Let that sink in for a second. This landmark hyperscaler lease agreement is the exact catalyst that lit the fuse on yesterday's 5% rally. When a macro deal of this sheer magnitude drops, it completely rewrites the asset's underlying narrative, right? It injects a massive amount of institutional confidence, and as technical analysts, well, this is exactly the kind of spark we look for.
So, what was the immediate fallout from that catalyst? Well, APLD officially shattered its medium-term falling trend channel. It just blew right through it. This is definitive technical confirmation that the sellers have totally lost control. Fueled by that hyperscaler news, buyers are stepping up aggressively and pushing the stock straight into a short-term bullish phase.
Moving right along to Section 2, mapping the technical indicators.
With APLD hanging around 34.74 right now, we really need to figure out where our ceiling and our floor are at. Immediate horizontal resistance is sitting right at that $34.99 to $35 psychological barrier. If we break through that, our target is $36.35. But look, as defensive traders, the floor is absolutely what matters most. We've got local support at $31.50, sure, but the true line in the sand, the really important one, is the major support at $28.45. Why? Because it aligns perfectly with the rising 200-day simple moving average. That is a deeply fortified level.
Layering in momentum, the Relative Strength Index, or RSI, is sitting right at a neutral 55.36. And what's great about this is that even with a 5% rally, the buyers haven't exhausted themselves yet. We are nowhere near that overbought 70 level. That tells us the stock absolutely still has room to run before technical traders start taking their profits.
Now here's where things get incredibly lucrative. We're looking at a massive 98% implied volatility for the June 5th expiry. If you sell options, you already know this is an absolute goldmine. The market is pricing in these huge expected moves, which wildly inflates the option premiums. By playing the seller here, we can extract maximum cash value for the risk we're taking.
And to cap off the technicals, the price is just sitting comfortably above both the 20-day and 200-day simple moving averages. The 20-day confirms our short-term bullish momentum, while the 200-day proves the broader long-term trend is still beautifully intact. With this dual confirmation, we've got exactly the edge we need to structure our trade.
Okay, Section 3, the trade setup itself.
Let's get into the exact mechanics. The strategy we're looking at is selling to open a cash-secured put expiring on June 5th, with the strike price deliberately set way down at $28. For taking on this obligation, we are estimating a premium of $1.50 per share. That means you pocket a clean $150 up front, literally just for agreeing to buy 100 shares of APLD at $28. And remember, that only happens if it actually drops to that level by expiration.
Which brings us to Section 4, the strategy and rationale.
So let's talk timing. Assuming we're starting right around May 1st, a June 5th expiration puts us roughly 35 days out. In the option selling world, 30 to 45 days is the absolute sweet spot. This is exactly where theta, the metric measuring time decay, accelerates the fastest in the seller's favor. Every single day the stock doesn't crash, that put option bleeds value, putting the math heavily on our side to close early for a nice profit.
And this comparison is just staggering. While retail investors might be out there chasing the rally and buying shares at $34.47 today, this strategy secures an effective entry of just $26.50. Think about that. If we're forced to buy at our $28 strike, we subtract the $1.50 premium we already pocketed. Boom! That creates a massive downside buffer well below current market prices.
Finally, Section 5, the defensive safety net.
Look, let's say the market totally turns and APLD drops below $28 by June 5th. You get assigned. Okay, you buy the 100 shares at $28, but because you kept that $150 premium, your cost basis is still an incredibly low $26.50. But you don't just sit there. You immediately rotate right into the wheel strategy. Holding those shares at a steep discount, you start selling covered calls against them, collecting even more premium while you wait for the bullish trend to resume. It literally turns a worst-case scenario into an ongoing income machine. I think this quote perfectly sums up the profound discipline of this setup. Remember that major support and the 200-day moving average sitting right around $28.45? By selling the $28 put, you are essentially telling the market, I refuse to chase this 5% rally. I only want to own this stock if it cools off and mean reverts to its long-term average. You're enforcing incredibly strict entry criteria, and the best part, you get paid to wait.
So, is setting a mean reverting safety net the absolute smartest way to play a high-flying, news-driven breakout? I'm going to leave you with that to ponder. It for sure offers a mathematically sound alternative to just buying right at the top. But hey, thank you so much for watching this explainer on APLD's technical analysis and our cash-secured put setup. If you found this valuable, please go ahead and like and subscribe for more data-driven breakdowns. Catch you on the next one.